Today's what you'd refer to as eventful in the markets with all of the moving pieces. We started off this trading week pretty optimistic, but that was very short-lived. But heading into this week, it was real joyous, real happy, just because of all of the good news that we've gotten lately. We've gotten hope at the end of the tunnel for tariffs. Maybe not so much now. Then we got that jobs beat that wasn't really so good. We got the big beautiful bill passing, being signed into law. Then the Middle East ceasefire still holds. But leading into this week with all of the hope and optimism at these all-time highs for stocks, Justin Walters with Bespoke Investment Group just pointed out the fact that, hey, regardless of any of the news going on, the market came into this trading week very extended with 57.2% of stocks in the S&P 500 recommending they were overbought heading into the day. And what they were really basing it off of were, you see these little lines around this chart right here? This is what's called a Bollinger Band. And in the last 8 sessions, 7 of those were at the high end of this band. And what the Bollinger Band shows is that it was a popular tool among investors and traders, and it helps gauge the volatility of stocks and other securities to determine if they were over or undervalued. So you see that we kind of fell off of a cliff leading into the end part of the day. And this was around some of the news we got out today, but let's continue talking. So usually what happens with Bollinger Bands is that there's 2 scenarios. And let's just kind of go to the back end of this Bollinger Band so you can kind of see the trend. When it first touched the high end of this band over here, June 25th it looks about, it was either, hey, it's going to reverse back, which it kind of did, but then it continued momentum to the upside of the direction. So that's scenario 1. Strong momentum continues up. But, I mean, we just mentioned in the last quite a few sessions that's been the case. The second session is that we're maybe due to some type of pullback, and that pullback could start right now based on the news regarding tariffs, regarding these letters, regarding Donald Trump at these stock valuations. So that's exactly what we just got as people started scratching their heads about whether or not this news regarding all of this mess and where we're possibly going can impact the market's opinion of where we can go from now. And right as these stocks, just kind of start falling down, who knows? It looks like every single time we've touched the bottom end of this band, we ended up back at the top. So this could possibly be a buy the dip situation, but I'd say not absent in uncertainty. And we'll get into uncertainty here in a minute. But I just think this is convenient that MicroStrategy, Michael Saylor, announces that Bitcoin was not acquired during the period June 30th through July 6th. It still has the same amount of coins it had, and the last time they went on this dry spell was conveniently around Liberation Day, where the market was just a complete crap show. Also pointed out I thought this was interesting, that their losses for Q1 went from down, or they have losses of nearly $6 billion. And then as of the second quarter, it completely changed and went from losses of $6 billion to gains of 14 billion. So crypto really moves fast. But this all comes out as the stock market's getting a little spooked based on what could happen. It could be regarding whether or not the taco trade's really a good trade to make or not. And Michael Saylor posting on Twitter X that some weeks you just need a hodl. How convenient. And then it's this chart of MicroStrategy purchasing Bitcoin. And looking at this chart, it just makes me feel like he's hinting at some type of pullback. And there's just so much uncertainty out there. There's this thing called the Trade Policy Uncertainty Index. And it's at its 16th highest day since the start of this index being tracked, since 1985. And most of the highs that we see are pretty recent. And the pause for reciprocal tariffs deadline is just getting closer and closer, so we'll see what happens with that. But regarding the news that had the market moving the way it moved today was regarding Trump with tariffs. Let's start there. Trump tariffs, I am pleased to announce the United States tariff letters and our deals with various countries from around the world will be delivered starting 12 p.m. Eastern, Monday, July 7th. So that's today. And then he also, let's stop here. So he sent off these letters, then he went on Truth Social and started like showing the proof, because Trump doesn't always chicken out. And that goes back to that trade. Trump always chickens out, that taco trade. It looks like they're trying to get back up to this middle point on these Bollinger Bands. But I digress. So he sent out some letters, and where we ended up landing right now with some of the countries we got some news on is South Korea, Japan. Both of them got a letter stating that their rates will be around 25% or at 25%. And that's of the 15 letters Trump is sending out this week, right after floating that rates could be anywhere between this 10% to 20 to 30 to 60 to even 70%. And being beyond 25% if these countries start trying to retaliate based on these reciprocal tariffs being put back in place. And then he also went out and put that any country aligning themselves with the anti-American policies of BRICS will be charged an additional 10% tariff. There will be no exceptions to this policy. So this is right after this BRICS, this group, voiced concerns about the rise of unilateral tariffs and non-tariff measures that they could try to take to walk this back a little bit. Pretty much the sum of this is that they don't really like the tariffs. And BRICS is made up of Brazil, Russia, India, China, Saudi Arabia. These huge hubs, these big trading partners of ours that we're supposedly negotiating with on our tariff rates. So it's just not looking good, y'all. It's super uncertain, and I think that just goes right back to the market, the stock market, MicroStrategy's point of view on whether or not they should be buying Bitcoin right now, at least. I'm sure they'll continue again, but just right now they want a breather. It just kind of all aligns up. So now the idea is that this 10% baseline that we thought was maybe a ceiling is viewed more as a floor rate now, and that now the tariffs can be much higher than expected previously. Now, we got some news from Scott Bessent today, Bessent, that he's hopeful that everything's going to work out fine. He did have to mention up to the, hey, what happened to the 90 deals in 90 days? Y'all were promising and super happy about it. And what he said is, hey, it's cool. We prefer quality over quantity, and that he expects several announcements over the next 48 hours. And who knows if those announcements were just Trump plopping the letters all over the place, and then maybe that drives some urgency to get to negotiations. But he's focusing on 18 countries that make up 95% of trade, overall trade with the U.S. And he also hinted at this August 1st deadline, and that if no deal is reached by then, that we can see some of these tariff rates bounce back to their Liberation Day tariff rates, which would be no bueno. We did get the European Union still aiming on some agreement in principle by Wednesday, so who knows how any of this is all looking overall. Right here you can see this chart of some of the tariff levels that were revealed today. Japan, South Korea, and then some of these other countries. You got Thailand on here, so you could pause the video and look at those real quick. But it just seems like they're going to continue on this path because something needs to happen. We had the big, beautiful bill pass and be signed into law. And what did that do? Tax cuts and government spending. So increasing the deficit, and they have to make their revenue to be able to keep the money going for this capital spend that they're spending. And they do have leverage right now to continue to negotiate. So I kind of feel like that's why it's all coming in so powerful right now, because when you think about it, the economy has been performing pretty well. We got stocks doing pretty good. And what's everybody say about July? Well, July is one of the best months of the year. That's one of the great months of the year for stocks. And then on top of that, the labor market appears in good condition. No large sign of layoffs. Inflationary data is good, as in it's not rapidly rising despite these tariffs being in place. And then the list just continues. But some have, somehow they still find that this debt, the gap between revenue and spending continues to widen. So that's the problem. That's why they have to negotiate these tariffs, because they need money to keep the lights on. Like, let's just use that analogy. And as this continues to widen, that points to more supply of treasuries, the need to issue more treasuries during inflationary tariffs that put more pressure on the central bank, on the economy, on everybody. So an example of some pressure right now due to these tariffs are insurance costs, health costs. And what we see right here is that Sarah James said that that it might not take until 2028 for the industry to regain its equilibrium as provisions of the recently passed tax and spending package kick in. So this is more fiscal related. Insurers have flagged various factors to explain the higher healthcare spending, such as rising mental health care use and costly drugs, a category that might sometimes include the new weight loss and diabetes medication category known as GLP-1s. The new legislation passed this last week will shrink the number of people with insurance, particularly Medicaid coverage, and thus will change the health and cost profile of the enrollee pool, creating uncertainty for insurers. So the uncertainty is widespread right now. Federal subsidies that help people buy Affordable Care Act marketplace plans are also set to drop next year. The Trump administration recently finalized a rule that tightens the requirements for signing up for ACA coverage, and it's projected to cut back the number of covered people by nearly 17 million over time, according to Congressional Budget Office estimates. Seeing medical cost pressures in all three lines of businesses, which is expected to continue into the second half of 2023. That's the past, Joel. So what I see from this is just increasing costs for consumers and the businesses. And this could be due to tariffs impacting the prices of medical equipment and supplies and services. And then also the big beautiful bills, tax and spending, cutting spending in these healthcare industries. So those are just some of the inflationary pressures. And then despite that, while the supply for treasuries is expected to increase from the deficit increasing, we have the inflationary tariffs, increases inflation expectations, higher yields due to that. And then on top of that, the trade war is a thing. So people who buy our treasuries and lend the government money are kind of salty right now because, hey, like, y'all are trying to put tariffs on us. And then at the same time, with the Fed that doesn't want to cut interest rates because of the fiscal policy going on, because of this trade war, this tariff chaos that's going on. So all of this just points to higher yields on these treasuries. And whenever treasury yields go up, bonds go down, but higher treasury yields leads to higher expenses, higher borrowing costs. And that's exactly why Trump keeps on pressuring and bashing Jerome Powell over at the Federal Reserve Bank to cut rates, because that leads back to what the government has to spend money on. And they usually borrow because we're running a deficit. And when they have to borrow money, you got to pay back interest. And those monthly expense payments are huge because of where the rates are. So it's just this endless cycle of spending problems, and you just wonder how you can even go about fixing it. Which people ask these questions. There was this survey that happened, and a survey of central bank reserve managers commissioned by UBS finds that nearly half thinks that restructuring the U.S. debt is a plausible scenario. And then other findings that might alarm investors were that 2/3 of the canvassed were concerned about the independence of the Federal Reserve, and almost half were troubled by the quality of the U.S. economic data and perception that the rule of law was weakening. So it's looking super iffy out there. Who knows where we're actually going to go? It's just uncertain. And at these stock valuations, where the economy's at, we're just walking in the dark right now. We don't know where we could wake up tomorrow. But let's get back to this taco trade, because who knows if that's the case or not. We could bounce off of this bottom Bollinger Band and continue trending up to these all-time highs and higher highs. But, I mean, we're getting deeper into the high territory. I mean, stocks have just been straight up. But it does seem like there's this realization of, well, we don't know what's going on. And, like, I don't feel comfortable about that kicking in right now. So there's this piece right here. Wall Street is cautious about the market rally. What will really drive stocks right now, by Martin B. And the parts that I highlighted is that LSEG data suggests collective earnings for the S&P 500 over the second quarter are likely to rise just 5.8% from last year, a sharp slowdown from 13.7% pace over the first quarter. There's that part about July, usually the best month for stocks. And then here's right here where we refer to the valuation of stocks being expensive. This is what we're talking about. We're talking about forward earnings in the future. The S&P 500 is trading at 22.2 times Wall Street's earnings estimates for the next 12 months, which is pegged at around $280 a share. Also, the so-called equity risk premium, a measure of the extra risk investors demand to hold stocks over risk-free treasury bonds, was last marked at 2.37%. Is really, when they say 2.4 percentage points, they're rounding up because these basis points, 200 basis points is 2%. So 2.37 basis points is 2.3%, near the lowest level since 2001. And they're looking at forward earnings. So that's what people's referring to when they talk about these stocks are trading at expensive valuations. It's all back to what the earnings are versus what they're expected to be versus how they come in. And if, like, with stocks being so happy, especially over the last few months, you just don't know where we can go because a lick of bad news that points to, oh, like this is happening. We could see us fall all the way back down in this yellow line over here. 578 is where I got it. Or sometimes they say when you fall, the last all-time high will serve as a support. So, I mean, if we were to fall, we'd probably fall back down to the 611. But honestly, though, there's what's called a dead cat bounce. And then just think of when you drop something, how it like just kind of like plops off the ground before it like lands again. We could probably bounce off of this top blue line at the top of this Fibonacci retracement line, bounce off of that, and then who knows where we go from there. But y'all, this market is not absent uncertainty. I'd assume the uncertainty will continue as even things unfold and we get closer to these deadlines. We'll probably even be more uncertain in the future than we are right now. But I'll keep on covering everything. Hope you're doing good. Hope you're having good luck out in the markets. I'm here for the long term, y'all. I'll be back tomorrow to report what's going on, and I hope your day is a blast. I got some basketball to go play.